John, thank you very much for making the time to talk to us today. eServGlobal has got two parts to the business. Can you explain what each does?
Yeah, that's exactly right. eServGlobal PLC is the home for HomeSend and for a core software business. HomeSend is a separate company, but it's built around a hub that enables cross-border money transfer. And that is a joint venture with the majority shareholder, MasterCard. The other side of the business is a software business. We describe it as the core business, but it's been the long-term business of eServGlobal. And it creates software and sells it primarily to mobile network operators, essentially in the Middle East and Africa. Now, all of our 110 or so people work in that business. We provide no resources or direct costs into HomeSend, which is a separate company, a joint venture that operates as a private company registered in Belgium. So the only part of eServGlobal PLC that operates within HomeSend is myself as a board director of HomeSend, as well as eServ itself, and my colleague James Hume, who's the COO of eServGlobal core business, the software business, but like myself is also a director. So all our costs and people are in the core software business of eServGlobal, and just myself and James are the assets, we hope, who work on the board of HomeSend itself.
So your costs of you and James, does that get covered by the core business or by HomeSend?
By our PLC at eServGlobal. eServGlobal's got about 35.6% of the shares in HomeSend, and the rest are MasterCard.
So can you tell me more detail about HomeSend?
Sure. HomeSend operates a hub that enables frictionless cross-border money transfer in a faster, more efficient way than traditional methods. The hub model is quite important because it enables an any-to-any approach. So this enables a money transfer organization to connect to a bank, to connect to a disperser through the hub. It also enables many types of different terminals, such as a mobile phone, a card, a bank account, to all interact with each other. HomeSend has got customers in 100 countries, and it enables access to around 3 billion bank accounts.
And did HomeSend come out of eServGlobal and the mobile transfer within eServGlobal?
HomeSend was established by eServGlobal and its original partner, BICS, which is the Belgian telecoms operator, back in 2009. And then in 2014, MasterCard came in and took the majority of the shares as a joint venture partner. Today it's MasterCard and eServGlobal as the partners in the business. Since 2014, MasterCard has wanted HomeSend to look more like a MasterCard company. That's people, processes, compliance, such that HomeSend was successfully able to apply for and receive a financial institution license. Going forward, MasterCard is expected to be the primary route to market for HomeSend.
So talking a bit more about HomeSend, what's the size of the global money transfer market?
Well, the original market we faced was a market of some 600 billion US dollars, and the usage cases were typically person-to-person transfers around the world, and that might be a construction worker in the Middle East sending $100 or $120 or $80 a month home to his family in India. Or it could have been a maid, perhaps in Paris, sending $75, $112 home to her family each month in the Philippines. But as time has gone on, the much bigger prize is clearly the business-to-business market, as primarily handled by the banks. And that's potentially around a $22 trillion market per year. Now, it'd be naive to think any one company can get all of that. And we don't know the HomeSend's final aspirations for their share of that market. But any company that could capture 1% of that market would be handling a volume of $220 billion per year. And that's a really significant opportunity. And then the business model that underpins that is that HomeSend aims to take a small skim of each transaction that goes across the hub. And that could be significant.
So what does HomeSend offer that the legacy systems don't offer?
Well, I'm sure we've all had experience of sending money internationally. It's not a very satisfying experience. But for the banks as well, it's not an easy thing to do. They have lots of aspects to their business. It's very tough for them to offer a fast, transparent, cost-effective service without significant investment. And all the time, the compliance burdens go up and up. So HomeSend offers a near instant, frictionless, quite transparent, very cost-effective service. Because HomeSend itself doesn't face the consumer market, but is more of a white label behind the scenes, then its own costs are very scalable. They don't have to flex with the number of individual customers. Clearly there are costs it has to incur, but they are not particularly related to volume. What's also different from a lot of the fintech market, and there's, as we know, an awful lot of fintechs of all types and sizes. Number one, HomeSend has, as its majority shareholder and partner, who it works closely with, MasterCard, which is one of the strongest brands in the world. And secondly, HomeSend can help banks with issues they themselves wish to solve, with opportunities they wish to take. It doesn't have to operate merely as a competitor, whereas a lot of fintechs seem to cluster around the language of unicorns and disruption. What's different is we can help banks meet challenges that they wish to meet.
And it's basically the technology that's different from the legacy systems.
It's the technology and the approach. And the thing is with legacy systems, to get from a legacy to design a whole new system is often very complex and can take many years, whereas HomeSend has been designed specifically for the digital environment. And one of the things that drives HomeSend is that desire to create a much better consumer experience. You and I have been using smartphones probably pretty well since they came out, but we also remember the world, well, I remember it better than you probably, but the world before that. But increasingly, younger people, they have only known this more on-demand world. And banks want to respond to that. They want to offer a better consumer experience because they don't want fintechs eating their business. They want to match what their customers want in a better way. And in our small corner of that, we can assist.
So moving on to what you call the core business, can you tell me a little bit about what's been going on there?
Well, it's no secret, of course, that the core business lost its way a few years ago, primarily in terms of costs, the type of business it was trying to secure, and that was around not really having the right offer to the market. So we spent the last couple of years really trying to restore the business to health, which we've all but done. Now, the hard facts of that are we've now more than halved the cost base over those couple of years, and we've clustered a business now around a small number of long-term, high-quality, stable customers who we've known for 10 years and more. And the result is quite a good business that should now return to growth in the second half.
And when do you see it returning to break even?
Well, we still expect to break even on the current year, and we've already secured most of the business in hand to make that happen. The rest is we've got to execute against our pipeline over the rest of the year. And that's a strong pipeline clustered around mainly existing customers. But quite positively looking forward, on top of that, we should enter next year with a lower cost base still, more than half covered by recurring revenue, which starts to be a much more comfortable position, and with a backlog covering most of the gap. So that's our aim, and there's every opportunity therefore of generating a positive EBITDA in 2019, which turns this business back into an asset.
And with the recurring revenue, is the 50% cover about what we should continue to expect, or is that likely to increase?
Well, my preferred operating model would be to keep building the recurring revenue, because from the recurring revenue you then get sticky adjacent revenues. So if we secure a customer, then an initial implementation tends to give you 3 to 5 years of further investment from that customer in the relationship. But some of our customers we've had now for 10 years and more. So that should imply we can keep building that recurring revenue, but the cost base will continue to come down, and therefore those two lines start to converge.
And how did you originally get involved?
Well, I joined as a non-executive, and some of us on the board and some investors became increasingly concerned that the company was losing its way. And in the end, the board asked me to step up to be chairman of the company. And luckily, I was free to do so. And I've had interesting times ever since.
And it must be quite rewarding now seeing it all come to fruition.
Yes, it is rewarding. I'm really pleased. We've got a good team. There's some really good people in the company. Frankly, if they're not good people, they've gone. And we have great customers. Our customers are primarily tier 1 type telecoms operators. They're people like Zain, where we have 4 of the 8 affiliates who use our software. They're Ooredoo, they're Do. These are big names in the regions in which they operate, and they're very stable. And so that gives us a real referenceability going forward when we look for more business.
And which regions are your predominant regions?
It's primarily Middle East and Africa. Along with smartening up our offer and cutting our costs, we've gradually pulled away from some less stable regions in order to get this clustering around the high quality customer base. And the markets in these regions are slightly different to the West. Most of us have a contract phone, but in the Middle East and Africa, 90% of the mobile phones are prepaid. And so it's a core mission critical capability for a telco to be able to manage the electronic voucher distribution and recharge to those customers. And we at eServ provide those core mission critical systems. So we're highly trusted. Then on top of that, we're also a leader in mobile money, because in these regions, and to be honest, increasingly in the West, people are using their mobile phone as a banking terminal and as access to financial services. And on that, we know a lot and have been involved with a lot of implementations in the regions we serve.
And are there any risks in these regions?
Well, we've tried to move away from the riskier regions, I think very successfully. That was dragging us down. But I go back to the bulk of the countries we operate in now are reasonably stable. And what's very different to the West is the West has a habit of plunging into a recession all at once. Whereas actually we have slightly more diversity because of the regions we operate in, and therefore the balance of risk just slightly changes, but it's not a negative thing.
So what are your aspirations for eServGlobal in the short term and medium term?
Well, I'm going to go back to the kind of two companies under one tent, as it were. So the core software business, we expect to return to break even. That's being driven by a very pleasing return of order flow, which we expect to continue over the year, and gives us the ability to enter next year with most of our break even covered by recurring revenue, and we hope a good backlog to take into the year. It gives us every opportunity of moving to an EBITDA positive position. So what would evidence that coming along? Good order flow in second half, and we'd certainly be talking about that as it happens.
And it's looking good so far?
Yeah, we feel very positive.
And for HomeSend?
Well, HomeSend has been facing the market of money transfer organisations and typically usage cases involving migrants. What we've been talking about, however, when we look forward, is this 22 trillion market with a much richer set of usage cases, including business to business. And it's that traction with banks where from now on in, I look forward to seeing evidence of traction. What would traction mean? Traction would be a build-up of volumes based on different types of transaction and more quickly than we've seen till now.
And when you sign up a bank, how long does it normally take for the process to be bedded in and for them to start actually making transactions?
Well, that's dependent on a range of factors, and it's the size of the bank, the complexity of the way they currently wish to do it, what experience they wish to offer to their own customers, whether they need to do some work around their offer, not just around the technicalities of linking to HomeSend. So fairly broadly, it looks like around 3 months to 18 months, which any software company would probably give you that type of answer. Okay, strictly HomeSend isn't a software company, but it has some of that complexity. There are examples of very quick implementations and examples of much slower ones, which are more time to pace to the bank's own commercial and technical considerations that are unique to that client.
And presumably they start with a very small number of transactions to make sure it works okay, and then they'll scale as they see it's working well.
Any project in the IT world tends to have a bit of a natural flow from, yes, it works fine in a test environment, now let's do a live test or pilot or friends and family. It's another way people describe that. Then you tend to move to a live launch, and then there's another phase where you move to the bigger volumes when all the confidence is there and people know that everything, all the functionality works as expected. So there are a few phases within that.
And for HomeSend, is it very labour intensive to onboard banks, or is it just switching a switch?
No, it's certainly not switching a switch, but it's not very labour intensive for HomeSend. It's the planning and implementation by the client that is the gating factor. It's not labour intensive, not so much for HomeSend.
And on the core business, you mentioned about corporate activity. Can you say more?
Sure. Well, we're on the point of having restored the fortunes of the core business and turning it into an asset again for the PLC and its investors. However, it's burdened by PLC costs, and if the right big brother or twin sister came along, then they could accelerate the business much more quickly than we could potentially without that, and perhaps bring lots of opportunities for cross-selling and real synergies that would really take the business forward. However, if the business stays with the PLC, it's not the worst situation in the world to contemplate 2019, where we should be able to enter the year with about 6 million euros of recurring revenue, with a lower cost base than we have now, so covering much more than half with that recurring revenue, and entering 2019 with a good backlog of orders to hand, leaving not that much more work to do to generate an EBITDA positive year. So that's quite good for the PLC. So it's right that we're open at this stage, and we'll just see how that goes.
So what should investors look forward to for the rest of the year?
Well, with the core business, further confirmation that the business is now returning to growth based on that improving order flow, which we expect to continue. And then we've got the opportunity to enter 2019 covering most of our break-even point with recurring revenues, and we expect a good backlog such that we can reach EBITDA positive during 2019. When it comes to HomeSend, then evidence that the traction with the banking market is really taking off, offering the potential to really accelerate revenues.
So how will we know that we're really getting traction with the banks?
Well, what I'd look to see is that overwhelmingly new customers being onboarded by HomeSend are banks, and those banks are then moving through from initial phases into proper volume launches, therefore giving an acceleration to HomeSend's overall growth.
John, thank you very much for your time.
No, it's a pleasure. Thank you.